The number of the week is 68%. This is the number that's affecting the market more than any other number. I'm talking about the dollar. I'm talking about gold. I'm talking about interest rates, and I'm talking about the stock market. 68% of people believe the Fed will raise interest rates in December. We've shifted from below 50% to above 50%. And this number, the fact that now people think that they're going to raise interest rates in December, is creating havoc through all markets. Hey, everybody, I'm Courtney Smith with your weekly TradeSmith here, bringing the hammer to the markets for over 45 years. I still feel like a baby. Let's get right into this because big news, it's a very important week coming up this week. First of all, this is very important, and it's coming up every week. Now, S&P 500, look at this. In the last week, just as we discussed last week, I told you it wasn't really... Anyway, here we are. We sold off. We're now down at the bottom of this range. Technically, this is a descending triangle formation. Technically, these are usually broken to the downside. This is something that's going to be pretty shocking. We're going to get into this later. I want to talk about seasonality. So, look, this week is going to be critical. One of two things is going to happen. Write this down. The market will either go up or it will go down. What? I know. Alert the media. Here's the deal. If this descending triangle is valid, it's going to crack the lows and we need to be getting short again. If the seasonality is normal, then we should see it crack the downtrend line and start to go up. Now, that's a pretty lame-o prediction, and I don't like lame-o predictions, but it doesn't matter. Our job is not to predict the market. Our job is to make money. So we've got, for fully paid-up members, we've got a portfolio that's perfectly positioned to make money no matter which way the market goes. But let's go further. So starting out, purple predictor negative, chart pattern negative. Let's go over here. Similar situation in the Dow, except notice that it's already broken to new lows. S&P got down, just barely broke below the lows we made in early September, but it's a clear breakdown here, and notice the purple predictor is even weaker. So the Dow is still the weakest of the three major indices. Here's the NASDAQ, the strongest of the three, but it's not a pretty looking picture either. Let's carry on. Seasonality. Now, this is important. Here's the deal. I'm going to stop for a second because it's important to understand how seasonality works. And basically what happens is that you'll see in a minute, we're expecting the seasonality to rally. We're looking for strong seasonality to start this week. So we're right there. We're right at the point where we should start to see this market move higher. Now, so far, as you can see, the market's moved lower. So this has got to turn bullish now. Now, here's what I want you to watch for this week. You can see I've drawn a red line there at the low that we made in early September. If the market breaks below that low, that means that it's showing weakness when we're in a seasonally bullish period. And that means that the seasonal signal has so far failed. Now, when a signal fails, that's a signal. A failed signal is a signal. And so what we look for as a trading principle is when the price action is bearish, in the middle of bullish news, that's super bearish. Let me repeat that again. Let me put it in a slightly different way. If the market breaks below that low on the chart, the red line, during a period when the market should be going up, that's extra bearish. It's extra bearish because in the face of bullish news, it's going down. So that's, once again, why this week is critical to see what happens. Now, once again, fully paid up members, we've got hedges on, so we're in good shape if the market goes down. On the other hand, we've got long positions that'll do quite well if the market goes up. So freebies, you've got to start to construct that portfolio to protect yourself on the downside. But we can't sit here and just assume that it's going to go lower. So you've also got to be prepared to be a buyer. Now, if you don't have any positions on, great. Sell if it breaks the red line, buy if it breaks to new highs. Let's keep it simple. Now, that price action makes it look like maybe I was looking for the blue line, all presidential election years. It could be that we're just bottoming a little bit late, but it could be the two that bottom later are the bottom two, which is that Hillary loses, the incumbent party loses, and all 8th years. However, I'm still sticking with the top two as the most likely scenarios, although I'm starting to reject the top one, which is the seasonality if the incumbent party wins. Now, the blue line is all presidential election years, and that's the most likely scenario, and I'm going to still stick with it. Let's carry on. Yield curve, no news here, still just not enabling us to have big bull markets. Asset allocation is continually moving. Cash, we're seeing cash move out of the bond market and into the stock market, and that's holding the stock market up. And you can see that even late this week, we had more money flow into the stock market. Imagine if the money wasn't flowing into the stock market out of the bond market. Think how weak we'd be. All right, let's carry on here. Stock market risk indicator. They're starting to get a little bit worried about this market. We sold off, and the market is kind of heading for the sidelines a little bit here. And that's not bullish, by the way. Global shares, even weaker than the U.S. shares. I was getting bulled up on them, but over the last 2 weeks, obviously we don't want to be there. Japanese shares, I'm quite bullish on Japanese shares, but they're staggering a little bit as well. Now, this is EWJ, but the one that I want you to use is DXJ, and it's much more bullish because it hedges out the weakness in the Japanese yen. So we're playing just the pure stock market. So next week, I'm going to shift over to DXJ. DXJ is the one to play. Bond market, look at this, new lows, collapsorama on Friday after trying to rally on Wednesday and Thursday. Then no, that's it, forget it, we give up. And that satisfies. I talked last week about the bullish divergence, but that's all taken care of now. It looks to me like bonds are going lower, and that means interest rates higher. This confirms, and the reason why is the number. The 68% that I started out with, people are just saying, oh my God, the Fed's going to raise interest rates in December. That's bearish for the bond market. That's bearish for the stock market. That's bearish for gold. That's bullish for the dollar. And guess what's happening? You got it. Exactly that. Bond key factors, they're starting to, look at that. We've got two of them are going up. One of them are going down. So the fundamental factors are starting to support the idea of higher interest rates on the bonds. The dollar, of course, I've been pounding the table the last couple of weeks here. That breakout was important. Now, that's an ascending triangle formation, and the objective is the top of the chart, okay? So we still have another 3/4 of a point, maybe another 75 basis points to go to reach the objective of the ascending triangle. But this price movement broke us above the highs in July, and the fundamentals are moving in favor of the dollar. What? Interest rates. We already talked about that. We have a stronger economy in the U.S. than other places, so money is flowing into the United States to take advantage of the stronger economic growth, the stronger investment climate. So look for the dollar to continue to move higher. Now, if the dollar moves higher, then that means gold goes lower. Now, our objective, we reached our downside objective on the chart pattern, but the fundamentals are not in favor of gold right now. We're seeing the dollar stronger. Gold is effectively a currency. Now, the other thing that disturbs me a lot is September and October are the seasonally most bullish periods of the year. Yes, a huge percentage of the demand for gold occurs in September and October as we go into holiday and wedding season in India. And India is 50% of the demand for gold. The market's cracking down. Now, remember what I talked about with the stock market. Here's a perfect example of what I talked about with stock market seasonality. The market's cracking down when it's supposed to be going up. If a market cracks down when it's supposed to be going up, that's extra bearish. So I guess I'm saying we might get 1 or 2 up days this week, but I think we're really setting ourselves up for a decline down to 1,200. Our indicators remain generally bearish, but it's still a mixed bag. Oil, I don't know. The fundamentals to me are bearish. But what's happening is we're starting to see an increase in demand. And, we first had that idea that OPEC was going to actually cap up production, but that idea is now long gone. And that caused the market to stagger sideways. Hey, everybody. Freebies, love having you here, but of course, I think you should sign up and get the super cool stock and options recommendations, less than a Starbucks coffee every day. And I'm not saying, hey, look, I like Starbucks coffee, but I like TradeSmith even better. All right, everybody. Also, coming up, want to remind you, go to that website up there at the top. Our amazing Stock Success School is coming up here. Premier Stock Trading Education. It's a peanut. It teaches the techniques many of the techniques I use to manage the #1 mutual fund in the United States. And by the way, there's 30,000 mutual funds. So when you're number one, I think it takes a little more than luck. Live seminar, 2 days in Las Vegas. You're going to love it. It's a peanut to attend. Check it out. All right, fully paid up members, hang on just 1 second.